If you look at 3%, when it touches it, what does it mean for equities?
I think it's more a psychological mark to start with. And actually, very interestingly, if you were to look at the trend channel for the 10-year yield over a much longer period, 25, 30 years, then you see the importance of the 3%. And this is why you see the market is so fixated on this level. In a way, for equity markets, as I said, it's this psychological hurdle. What's the implication? So far, we've seen more the yield curve flattening and the big question mark, why is the 10-year not moving? Why is it only the front end? And let's not forget the implication of the 10-year and the implication for equity valuation, and obviously the economic outlook is what markets will focus on. Though I think the volatility immediately that could relate to the 10-year breaking 3 is more psychological than kind of real data moving accordingly.
Okay, but Sonja, do we ever come back to the kind of the pre-financial crisis world of how bonds and equities function?
That's the great normalization, and I think not yet. This is a really long kind of adjustment process, because obviously for that to happen, we would really see central banks kind of take away their influence onto the bond market and the equity market. So yes, obviously we're moving towards the right direction, but we're definitely not there yet.
Sonja, are stocks cheap? And I don't say that as a light question. I mean, within the synthesis at Fidelity of our politics, our central banks, our interesting economics, are equities a good value?
I have to answer it depends, because what we would say is that the kind of beta trade definitely is less attractive, because we're really struggling to see broad-based upside in equity markets. What we would say is that you definitely have pockets, because the very strong bias within markets and the leadership and the kind of bifurcation we've witnessed over the past couple of quarters definitely means that there are pockets now that look a lot more attractive. And it's interesting how you see already within the earnings season now how the market reacts to, beats are no longer sufficient. It all depends on the outlook in combination, obviously, with the strength of the underlying business model. I think that's particularly true for the US, where we have had so much excitement in the last quarter of 2017 and early 2018 that you really have to come up with a stunning result to make your share price move from here.
And the pro question, folks, is with these rising yields, Sonja, do you care with competition to the bond market, competition to dividends? Do you care about the top line nominal yield, or do you care about the real inflation-adjusted yield?
Obviously, if you think about equity market risk premia and valuation models, then obviously the real yield is what is the driving force. This is why I've said earlier, I think there's a more psychological component to the fixation around the 3-year nominal in the 10-year. But nevertheless, it's potentially a precursor, and this is why, again, we should not ignore it. But it's the real yield move that I think, if you look at the big volatility movements, has the much stronger handle on equity markets.
Okay, Sonja, give me a sense of, so we're looking, we're trying to figure out again the, some of the corporate credits. I don't know whether you benchmark it, compared to the European equities. So a move in treasuries entails a move in German bonds, in the Italian ones, like across Europe. What kind of direct impact does that have on the local equities?
Again, I think we should not forget the 10-year Treasury is still the guiding market in terms of the fixed income, and in particular because you might see nuances then coming out. We're expecting Draghi to speak this week, and that obviously will have an impact on local, not only rates but corporate credit as well. And I think in terms of corporate credit, we look much more in terms of are there any warning signals coming out of the credit market that we should not ignore within equities. I think that is definitely the lesson we learned back in 2007, 2008, where the signals were much clearer early on in high yield and corporate credit rather than equities. So again, I think this time round that's something we should have an eye on. And it's obviously interesting to see that credit markets have been much calmer so far than equity markets. So hence, I think it's this kind of ongoing reassessment, whether the weaker or the weakening economic data, particularly in Europe, are really telling us more than what markets currently are discounting.
I know we'll focus on earnings, but do you look at earnings to kind of, see the state of the company, or do you just look at forecasts because you're worried that trade tensions would impact them? So whatever chief executive says, it's almost more telling than earnings.
That's an interesting one, because if we again remember 2007, then we know that corporates actually have been lagging rather than leading indicators for things to come. And this is why, again, I think we try to then judge the remarks from CEOs against what we're actually seeing on the grounds. The whole area around trade tensions and protectionism is very complicated, because everybody knows that Europe would be the most exposed. 75% of earnings within the MSCI Europe are derived from overseas. So it's quite logical to assume that this is a negative impact. Yet the magnitude varies greatly depending on where we would see protectionist measures. So I think I've seen studies that obviously if you were to look at the car industry and you would have distinct measures hurting the car industry, that would be by far the biggest negative impact on overall growth and earnings.